Market participants. We have many key players in the market, and these are the main ones to look out for. So we have the commercial business and corporations, central banks, investment banks and hedge funds, Forex brokers and dealers, and retail. Based on the market participants and the character of the business, we should see heavy volume in various participants. So the business and corporations, the commercial side, you should see high volume. So central banks, when they come into the market, you will see high volume. Investment banks and hedge funds, you will see volume with these guys. These are the non-commercials, as well as the Forex brokers and the dealers. The retail, you won't see so much volume because retail doesn't move the market. All right. So let's start off with the commercial banks and corporations, right? So let's have a look at multinational corporations. They could be a firm engaging in importing and exporting using Forex transactions to pay for goods and services. So let me show you an example on the whiteboard. So we're looking at multinational corporations. I'll put that. So these are the guys that import and export. So for example, we have a UK company producing laptops, but they source their components from Japan. And they sell, so the UK firm sell their products in Europe. I'll just give you a prime example. Right, so we have a UK company producing laptops, sourcing Japanese components, which then sells the finished products to Europe, right? A UK laptop producer that imports Japanese components and sells its finished products in Europe. After the final sale is made, the UK firm was paid in euros. So they now have euros, which I'm sure they want to exchange back to British pounds. So the Japanese company receives Great British pounds, which then they want to convert to the Japanese yen. Okay, so these companies trade Forex to hedge the risk associated with foreign currency. So the UK firm may purchase Japanese yen in the spot market to obtain yen in advance of purchasing components from the Japanese company in order to reduce currency exposure risk. Yeah, so hedging against currency risk can add a level of safety to offshore investments. So that's what you will see with multinational corporations. Yeah. So let me give you another example. Gold mine, right? Gold mine produces gold, and therefore it will be impacted by the fluctuation of the value of gold. So as a result, they would need to protect themselves against losses. So these producers will hedge against price and put in opposite positions of the market. Yeah. So for example, if gold is going up, the gold miners will hedge against the price and start selling. Yeah. Their profits and losses are therefore nullified and they get stability in the operations of their business. So that's the whole pretty much idea of hedging against price for stability and to keep production costs low as well. All right. So when you see commercials hedging against gold, then you know what they're trying to do. So you will see a large amount of volume from these gold mine companies hedging against price, right? Same against with multinational corporations, right? That was that example right there. Okay. So commercial banks is one of the greatest volume of currency traded in the interbanks market. This is where banks of all sizes trade currency with each other through electronic networks. Commercial banks account for a large percentage of total volume. Banks will be trading with each other in the interbank markets, and this is where you'll see high volume. And these are one of the biggest players in the game. You've got commercial banks, multinational corporations, and gold mines. So this is where a large amount of volume will come out from, these guys here. Yeah? All right, so we have these guys here, which we will call the commercials. Okay? So the next players are the central banks. So central banks represent their nation's governments. So for example, if we had the central bank of Switzerland, their currency will be the Swiss franc. So that would be their native currency. Yeah. And they participate in the markets and are very important players to look out for as well. Open market operations and interest rate policies of central banks influence currency rates at a large extent. Central bank is responsible for fixing the price of its native currency if the currency falls out of the given range. If there was a given range from 1 to 100 and it slips out of that range, central banks will come in and intervene. So it'll bring it back to a reasonable range to stabilize the currency, right? For example, we have a range here, and that's their range, right? From there to there. If it comes out that range, then the central banks will intervene. If it comes out the range here, the central banks will intervene to stabilize the currency, right? That's their job. Another example central banks may do, they may weaken its own currency by creating additional supply during periods of long deflationary trends, which is used to purchase foreign currency. This effectively weakens the domestic currency, so it making exports more competitive in the global markets. Yeah. So central bank uses various strategies to calm inflation. By doing that, serves as a long-term indicator for Forex traders. A central bank is responsible for fixing the price of their native currency. This is an exchange rate regime by which its currency will trade in the open markets. So you will see various regimes. You have floating regimes, fixed regimes, and pegged. So pegged means that it will be pegged with a basket of currencies. So with fixed, they're restricted, and with floating, they can do what they want with it. Yeah? Most currencies these days are floating. So that's central banks. Investment banks and hedge funds. So investment banks and investment managers act as dealers for their clients. So these will be large, substantial accounts. And they trade currencies and a mix of markets such as pension funds, foundations, and endowments. Portfolio managers are hired by these investment manager. Pooled funds and hedge funds make up a substantial amount of volume in the markets. So these will be the non-commercials we're looking at. This will be the quick money, and we look at the commercials as slow money, and we look at the non-commercials as quick money. Okay, so investment manager with an international portfolio will need to purchase and sell currencies to trade foreign securities. They also make speculative Forex trades, while some hedge funds execute speculative currency trades as part of their investment strategies. Portfolio managers are hired as part of the hedge funds to manage portfolios. Hedge funds and portfolio managers use various strategies. The most popular strategy is the global macro strategy, which by now you should have learned in module 1, which the idea is to invest in a sizable position in markets that deal with macroeconomics, to deal with macroeconomic trends, which provides flexibility. The issue with this strategy is all dependent on timing, which in module 2, we will be going into volume which is our timing mechanism. Speculators really only buy and sell the markets to make a profit from it. Yeah? So there's no business strategy as the end goal. The number of speculators increase when the market volatility and sentiment is high and in the market's short term. That's pretty much investment banks and hedge funds. So these are going to be our non-commercials to look out for. So we're going to keep these up here as part of our commercial area. So the next players are the Forex brokers and the Forex dealers. Now, the brokers conduct transactions with clients, like individuals, on their own behalf at their own expense. Forex brokers conduct operations for their clients, who are often large institutions, all companies with financial resources. The broker's income is commission because they're dealing on a bigger scale, right? So the Forex dealers conduct transactions with clients who are individuals like you and I on their own behalf at their own risk and their own expense. The dealer's income is a spread or fee. Forex dealers work on a margin basis, providing leverage for customers to trade Forex, right? So the dealers will give you a leverage. Pretty much you can get any leverage from 500 to 1 and start trading Forex. So all you need really is £100, $100, and you can start trading with a very high leverage. So Forex dealers will offer clients leverage based on the law of their country or where the client resides in. I live in the UK. I can get a 30 to 1 leverage if it's UK regulated. So if I want a higher leverage from that broker, I can contact them and they can set me up with an offshore account in the St. Vincent or the Grenada and apply for a 500 to 1 leverage. But my money won't be regulated in the UK. Even though the company's in the UK, my money won't be regulated. So the main intention of the Forex dealer is to have their clients carrying out as many transactions as they can so they profit from the spread and losses. It's a win-win for them. The Forex dealers will invite you to their training and class it as market education, yeah, which we see a lot these days. And their strategies that they have you trading wants you to open as many trades as you can within a day. Because don't forget, they profit, yeah, from the spread and the fees and any losses. There's a saying with these Forex brokers that 90% of retail traders lose 90% of their money within 90 days, right? So they want you out there trading as many times as you can within them 90 days so you can lose that 90% of the money. So these Forex brokers, they will hedge your position because they know you're going to lose. They're betting that you're going to lose, right? So they will hedge your position every single time. They get your losses, they get your spread, they get the fees, and they win with the hedge position. So they're making a lot of money from you guys, right? Forex dealers will offer the education on how to trade that works for them. Why would a Forex dealer who will set you up with an account manager to try and make you money, so think about it for a second, right? Why would a dealer who lend you money to trade on the Forex market to try and take their money? Yeah, it doesn't make sense. Just be aware with Forex dealers, if they invite you to a webinar, attend it and see what type of garbage they teach you. Yeah? They will never teach you about fundamentals. They will never teach you about volume. All they will teach you is technical analysis, trend lines, support and resistance. because they know it's garbage, right? So the last players are going to be us, retail. So retail market traders are individuals or small businesses that trade in the markets. Yeah. So most of the retail participants trade in spot market, whereas long-term interest operates in the futures market. This is because these participants only buy and sell when they have personal or professional requirements, and dealing with currencies is not part of their everyday business, right? So you might have a small business on a business venture for the one time, and they need to change some currency up. So they'll go into the markets and change some currency. So they'll use the retail spot price to change up some currency. The majority retail traders are individuals like you and I, whom are here to trade these financial markets. Majority of retail traders only trade technical analysis, who have no idea on how the markets work. So they see candlesticks, they think supply and demand is the only concept, or they see support and resistance is the only way to trade the Forex market, which is absolutely wrong, right? You have to understand on how the markets move, right? You have to understand why. You need to understand when, and you need to understand how. You will have a greater understanding in the Forex markets. With this course, you have a greater understanding in how to apply fundamentals along with volume and how to enter the markets using technical analysis. Now, not all technical analysis is wrong, so only limiting yourself to technical analysis is wrong. I would say 60% of trading is fundamentals, 20% is volume, and 20% is technicals. Yeah, so majority of it will be fundamentals. So that concludes our market participants. Just to go over them again: commercial businesses and corporations, central banks, investment banks, hedge funds, Forex dealers and brokers, retail. All right.